Hi, Mark Anderson here, mortgage banker with Paramount Bank. I am licensed to lend in all 50 states, and I would love the opportunity to earn your business. Please do call or text me at the number below anytime. I would be happy to help with your scenario. For today's mortgage rate update, we've got more good news. It's been pretty much good news all week, which is certainly a nice change of pace from last week when things were really, really touch and go and incredibly volatile. What we've got today here, this is a 2-day picture of mortgage bond prices. We have gone from the 103.8 level on the bond price up beyond the 104 level, and that beyond 104 level performance in the bond market is sustained for now. Today, we actually saw a big jump in the mortgage bond prices, which again, just as a refresher, as bond prices go up, that generally speaking, means that mortgage interest rates are going to go down. And that's what we've seen today. Overall, to give you some sense of scale, my average scenario today is priced out maybe 0.125% better than the typical scenario from yesterday. So we have actually seen a move down in the rates that is a sizable move. Should this be your time to lock in? My recommendation is going to be a very firm yes. I use a lot of language in these videos where I'm trying to hedge my bets because, you know, again, my fundamental belief is that anybody that tries to tell you they know what the rates are going to do on a day-to-day basis, they can't. We have to deal in probabilities. Today, we got a lucky break. The mortgage bond prices have sustained themselves and have improved. And that finally has caused the big institutional lenders to improve their rates, given that we have seen such a sustained level of price improvement in the bonds. There's a phenomenon I've talked about where when the bond prices first hit this 104 level, it didn't seem like we really got the benefit on our actual rate sheets that we would have expected. And my argument at the time was that I thought it would take a sustained period of at least a couple days of these bond price levels above 104 for us to actually see a translation into the rate sheets. We have seen that now take place. So this is good news. I think this is a very, very good time to lock in. Now let's talk about some patterns. This is over a 2-day period. If we bump out over the last month, I think this tells a very, very interesting story. There's a dividing line around right here toward the end of March where the Federal Reserve kicked into gear with heavy mortgage bond buying activity because there was this instability here. Way back toward the beginning of March, let's actually blow this up to 3 months so we can see when the rates first dropped super low. The bond prices at the time, around Friday the March 6th, hit 102.61. That is when we saw rates on, say, a 30-year fixed scenario at either 3% or maybe even sub 3% for very brief periods of time. We saw the 15-year rates get down very low. I think the lowest rate I locked on a 15-year fix was maybe a 2.625. And again, I'm throwing these rates out there. They're not meant to be quotes for a specific scenario. Your details will ultimately inform your quote. And of course, current market conditions will inform your quote. But this is interesting, and I wanted to point this out. The bond price is 102.61 here in the beginning of March. That's when the rates first dropped to their lowest levels. The bond prices now are significantly higher. The rates are not lower now than they were Friday, the March the 6th. What that tells me, and what I think that the general conclusion should be, is that, as I've said many times in these videos, the market fundamentals are not directly impacting rates in the exact way that we would normally expect. And the reason for that, I suspect, is because what's going on in the mortgage bond market right now is essentially an artificial stimulus program brought to us by the Federal Reserve. So one thing about that to keep in mind, as long as the pipe is open and the Fed is continuing to pump money into the mortgage bond market, we are going to see bond prices that are going to be relatively stable. I don't know when the Fed runs out of money. I don't know if the Fed knows when they run out of money. They seem to be able to print it whenever they like. I remember there was a quote from Ben Bernanke. They were asking him about, I think, the previous quantitative easing programs way back when. And he said, well, you know, I'm tired of people talking about printing money. It's just we go onto the computer. And that's how we add money into the economy. So this, I have to believe that there has to be an endpoint. There has to be a certain level of bond buying activity that the Fed can engage in, and there's a certain level that they can't. We have already seen an indication that they are buying less overall in mortgage bonds. I think the idea here is that as long as the Fed is pumping money into the market, hopefully at some point in time, we're going to get back to a normal market where some liquidity goes back into the mortgage bond market and the Fed can back off. But what they did this to avoid was this volatility back here. This is around when the rates first went down. There were these periods where the rates got really good and then they got really bad. Not bad historically, but bad compared to it. If you had talked to your lender, 7 days one way, got a quote, talked to him 7 days later, at this point, March the 12th or so, you were looking at a significantly worse deal. Same thing happened over here. We had a big drop off in bond prices. Rates got much, much worse. At around this time here toward the end of March is when the Fed started pumping in money into the mortgage bond market. And that really is the fundamental reason why we have seen such a sustained, good priced mortgage bond market. As soon as that goes away, I have to believe that the bond prices are going to come back down. So I just think that that is important to keep in mind as you weigh your decisions. Pricing today is very, very, very good. I think that you should strongly, strongly consider locking in while it is still good, because although we don't see the kind of spikes here in the bond prices that we saw in this early to mid-March period, although we don't see that kind of cycling up and down in the bond prices, as I've mentioned in previous videos, we have lenders that have capacity concerns. They're just not really all that interested in buying up the mortgage market by enhancing their pricing. We've got some other things that are limiting the upside associated with these high bond prices that we're seeing right now. So, long story short, I think you should lock in. If you have any questions, if you'd like me to lock in your scenario, please give me a call. Please do like and subscribe to this video. Please comment. I will answer your questions. Thank you very much.